What's up everyone, and welcome to Jayconomics. My name is Jay and it's a pleasure to meet all of you. On this channel, we take a look at anything related to finance with a strong focus on investing. So if that sounds like something you want to be a part of, then please consider subscribing and liking this video to help me on my quest to befriend the big, bad YouTube algorithm. What's up everyone, and welcome back to Jayconomics. Today we're going to be going through the Jerome Powell interview and breaking down what the Fed is seeing, and most importantly, what actions they will be taking moving forward. We're going to break down his comments and talk a little bit about how all of this impacts you as a long-term investor. Before we get into it, if you want to grow your portfolio exponentially, be sure to check out our Smart Money Squad Patreon. There are various tiers for your goals and budget. You'll get my buy and sell alerts instantly, my weekly watch list and entry points every Sunday, as well as updates throughout the week when I see something interesting in the market, and access to the private Discord. The link for that is in the description below. Now, if you've been following my channel for a while, you know that I'm here to cover all aspects of investing, whether that is mindset, strategies, and presenting ground floor opportunities into exciting, disruptive companies. Now, if you've been paying attention to the market lately, you know that things have been a little shaky to say the least. In March of 2020, the Federal Reserve lowered the Fed funds rate to virtually zero in response to the pandemic. If you are a newer investor, you may be wondering why the Fed funds rate is such a big deal and what impact it has on investing. When the Fed cuts rates, borrowing becomes cheaper. This means a decrease in mortgage rates, auto loans, and even credit cards. The belief behind this is that if people have easier and cheaper access to capital, they will be more likely to go spend the money. And in this interview, Powell was asked repeatedly how the Fed plans on handling interest rates and inflation. And this is exactly what we're going to do a deep dive on today. Powell started off by sharing his outlook on the economy. The Fed was given two goals by Congress: return to maximum employment and maintain price stability. This means both labor force participation and employment levels need to return to pre-pandemic levels, and we need to be at or slightly above a 2% inflation level. He states that this guidance is based on data and outcomes, not on predictions, and that an increase in rates won't even be considered until those goals are met. Regarding inflation, he expects there to be a slight increase after the economy opens due to the flood of money into the economy. He does not believe it will last longer than 2 quarters, and if it does, they will be extremely patient and wait until both of their targets are met to raise rates. He wraps up by saying that during the last recovery, fiscal policy reacted too early, which led to a long, slow recovery. They have no intentions of pulling back this time and are committed to going full speed until all of their goals have been met. Now, many investors did not like that Powell would not give them a timeline and believe that Fed rates will be rising sooner than many people originally thought. Now, the mistake that I see people making is paying too much attention to what Powell didn't say and not paying enough attention to what he did say and the powerful guidance that we were given. Powell did everything but scream at us that interest rates would not be rising until after job numbers were completely met. Now, as long-term investors, we have to be able to take the information given to us, study the data, and make decisions for ourselves. Currently today, there are 10 million fewer jobs compared to pre-pandemic levels. While some industries are thriving, many businesses will never recover. If you look at the employment rate over the past 10 years, you see that it took almost 10 years for the employment rate to go from 58% to 61%. Today, we are a little under 58%. Next, we have the 20-year chart for labor force participation. You can see that we are at the lowest numbers since 2015, with 10 million fewer jobs than pre-pandemic levels. According to Business Insider, 17% of restaurants in the United States have permanently shut down due to the pandemic. After taking a short look at these numbers, you have to ask yourself why investors think that interest rates will rise so quickly. Now, I believe that investors are underestimating the situation at hand. The market has been on a rocket ship for the past 7 months, and investors have seen record revenues and earnings from tech companies. Investors have seen their portfolios skyrocket, many reaching multiple all-time highs. While some people/industries have thrived, we must take off the blindfold and look around. How many restaurants will never open their doors again? How many small businesses had to cut employees or permanently shut down? Due to this, I do not believe that the Fed will be raising rates for at least the next 12 to 18 months, and more than likely, potentially longer. The economy has a very long way to go before it reaches the Fed targets. Of course, Powell and the Fed will have to keep their word on this, but that's the situation at hand right now. So again, you must draw your own conclusions, and you have to make the best decisions for your portfolio and your financial situation. There's no such thing as a one-size-fits-all in investing. However, here at Jayconomics, we study trends, we study management, vision, and fundamentals, and we do this in order to find ground floor companies that are going to exponentially grow our wealth over the long term. Now, yes, it's important to stay educated on current events, but do not get distracted by short-term instability. Determine what your long-term goals are, evaluate your own risk tolerance, and manage your portfolio accordingly. Most importantly, always remember that time in the market beats timing the market almost always. And that has been proven time and time again. And remember, as investors, we must have patience, and we absolutely must take emotions out of investing. The stock market is a device which transfers wealth from the impatient to the patient. Remember, if you are fearful and impatient and you sell low, there is always a confident and patient investor who has conviction, and that person is ready to take your shares and pretty much take your money. So choose companies that you are ready to hold long term. Be able to explain why you are holding this company, what the company is doing, their vision. Learn about the management, right? And then you'll have that conviction. Share price will always go up and down, sometimes for no reason. But fundamentals are what sustain a stock's value over the long term. If you learn to control your emotions and develop the skills that we preach here at Jayconomics, investing will bring life-changing rewards. Know what you own. Conviction plus patience equals massive gains over time. Weeks and days like these is a sale. It's an opportunity. That's what it is. Nothing less, nothing more. So that wraps it up for today's episode. I hope you guys enjoyed the video and that it gave you a good insight into what the Fed actually said, what Powell's words mean, and I hope that it potentially gave you a good idea of, where do I go from here? Take the weekend to think about it. Reevaluate your portfolio, your goals, and your risk tolerance, and act accordingly. And guys, if this video brought you some value, then please hit that like button for me, as it really does help the channel a lot. And if you want more content like this, then don't forget to subscribe and turn on that notification bell to be notified when any new video comes out. And of course, check out the Patreon if you want access to all of the perks, like our awesome Discord, and access to all of my stocks and plays in a timely fashion, and much, much more. And until next time, take care and invest smart.